Okay guys, so this is the outlook for this week ahead. Let's start with the macroeconomic themes. So the gold and silver ratio is at an all-time high while building a lot of momentum, and this month looks like a divergence from the seasonality. So seasonally, metals are short in the month of March, very short. But however, due to the obvious macroeconomic themes going on, you'll find that the metals are catching a safe haven bid as a lot of investors and traders are selling off on stocks and going long on metals and treasuries. So let's take a look at the gold silver ratio and see what's going on from a correlation perspective. So this is the gold to silver ratio on the screen here. This is the gold to silver ratio as it relates to silver. Now silver is typically inversely correlated with gold silver ratio, so as this tends to go up, you're going to find that silver goes down, as we can see here, and as they tend to come together, you can see that they tend to be good buying opportunities when either one of these tends to top out. However, they do tend to sort of track higher a bit together overall while maintaining a sort of ratio as a distance. So I will be expecting more on the long side on the gold than silver. Now let's take a look. Where gold is concerned, we can see gold is tracking along nicely with the gold to silver ratio. They are both pushing for some nice new highs, and I am by all means bullish on gold for the coming week. Where platinum is concerned, we can see platinum sort of is it is inversely correlated, as you can see here, and it looks pretty much like silver, and I'll be waiting to see where platinum goes this week. Palladium is also tracking the gold to silver ratio, but it's really interesting with palladium. Sometimes you'd find that they lead each other by a little bit, by a day or two. This is the weekly chart. Let's try to zoom in a bit. You'd find that sometimes one would lead the other by a day or two, so you'd find a breakout in the gold to silver ratio. Palladium follows. You might find palladium goes the gold to silver ratio, and therefore gold or silver may follow accordingly. So this is something to definitely look at as an indicator for the metals. So let's take a look at what else we have. Oil. So oil is really interesting this week. The oil demand is significantly low as a result of OPEC not being able to agree on their 1.5 million barrels per day cut in production. So as a result of the coronavirus causing massive global slowdowns in travel, the oil is at an oversupply right now. And this is creating a really interesting political and economic situation. Russia decided not to agree to this production cut for obvious reasons. Something interesting happened for the first time. The US has become a net exporter of oil. So the US finally has an oversupply of oil. And what we could be seeing here is a battle for market share, which is a big bearish signal because we're looking at a lot of producing countries trying to outproduce each other, flooding the markets, specifically at a time when there is less demand for oil. So this is a huge indicator for a bearish bias going into the next few weeks, actually. And I by no means believe that the downside on oil is over. I have a target overall of $35 per barrel, which we'll see as we go to the charts. Also, a correlation showed up on the US dollar with oil. We'll take. So this is US oil on the chart here as we hit the multi-year low going down to 41.50. For the first time in a long time, we can see that the US dollar is actually positively correlated with oil. And the last time that happened was in September last year, where they had also had a net exporting month. That is here, September, going up. There was a perfect correlation here, but going over here where we can find it, September. Again, we can see it tracked together as the US was a net exporter of oil. Their currency was correlated positively with the value of oil. So as we can see here, the dollar is going down for its own fundamental economic reasons. Oil is going down for its own fundamental economic reasons. This is a big indicator for a bearish bias from both ends on both oil and the dollar. Let's take a look at USD CAD as it tracks along with this. Let's take off the dollar here. USD CAD is usually inversely correlated with oil for obvious reasons. Canada being a net exporter of oil as well, we can see the inverse correlation is still occurring here, but there is more volatility on oil than there is on the US dollar CAD. But what's going to be interesting is seeing how that correlation relates to the fact that the US dollar and oil are now positively correlated. So let's take a look at that. So the last time that happened, again, like we were saying, was September 2019, where again we can see they tracked together mostly. This is a weekly chart, of course. We can zoom into the daily in a little while. And here we can see the bearish bias happening on the dollar. So we can expect something interesting to happen on the USD CAD, which we need to keep an eye on. All right, let's go back over here and see what else we need to do. The dollar. The US dollar index has fallen significantly over the last week. The Federal Reserve's cut their rates by 50 basis points, suggesting an obvious weakness to the euro and the yen. Now, I can't remember where I heard it, but this was supposed to be something to help boost the economy. That was the Fed's reaction to try to provide support. The analogy I heard was, if you punch someone in the face and they do not even flinch, you should probably run away. That's what the Fed did. A 50 basis points cut. This was the first time that a basis point of that large, that a cut of that size occurred since 2008. And it still has not been supportive of the markets. The markets actually continued to sell off despite that move. The markets are actually anticipating a further rate cut during the next meeting. And what we are finding is that the confidence and the sentiment is very much low, very much pessimistic when it comes to the US economy, especially with their handling of the coronavirus. Stocks are selling off, negative indicator, and we're expecting that further rate cut. That will be a definite indicator for a bearish bias in the dollar, which of course is a big impact on the currency markets because most currencies have some relation with the US dollar. Let's take a look at the euro. So the euro area is being affected by poor economic data already, minus the coronavirus. The UK left the EU. Germany is heading into a recession. We're looking at the coronavirus now compounding the impact of those things as it is spreading from Italy and beyond. Interestingly enough, just before recording this video, I saw an update from the BBC talking about Italy going into quarantine mode of its large city of Lombardy, where they have 16 million people in quarantine, and that's going to be a big impact on their economy. And they are one of the larger contributors to the European economy as well. So we will expect that to have some more negative impact on the euro currency as well as the European economy overall. What is taking place in Italy, in Lombardy, is actually restaurants. They cannot pack their restaurants full anymore. The distance between people who are in the restaurants must be at least 1 meter. And restaurants cannot make enough money without packing out their restaurants regularly. Gymnasiums are closed, swimming pools are closed, churches are closed, funerals are not allowed. Any sort of public gathering is basically not allowed. One government minister is actually infected with the coronavirus himself, and they expect to maintain this quarantine for the rest of this month, guaranteeing poor economic data coming out of Italy, which will of course affect the rest of the euro area. And with the exponential rates of growth and infection of the coronavirus, we can expect to see this type of measure being applied throughout Europe, which will further weaken the euro and supports or bearish bias. Now, the euro has been rallying for the last few weeks, which is against my personal bias as a result of my survey of the commitment of traders data as well as the economic data. And the reason for that support of the euro is really simply because of US stock sell-offs. So major investors who have been invested in the US stock markets have been selling off their stocks, creating a currency reconversion, which will then be bullish on the euro, which has been happening. So we will find that at some point there will be some exhaustion, or the economic impact of the eurozone will actually further influence the value of the currency than the stock sell-off in America. Let's take a look at Asia. Asia is straightforward. That's where the virus started. And what's really interesting from Asia is that the New Zealand and Australian currencies are both at an oversold level. They are currently bouncing back upward a bit, but the bias is still very much bearish. So I'll be looking at a sell position from any appropriate technical level, as I do not expect the Australian economy or the New Zealand economy to look attractive to investors, thus reducing the money flow going into that direction. Australia is highly impacted right now as a result of their economy being dependent on affluent Asians coming from Japan and China going into their school system, spending money in their service industry, and that is obviously not taking place at the moment. So we will find that the Australian economy would have suffered as a result of that. We will have to keep a look at their exports when it comes to iron ore and whatnot. So overall sentiment. The market sentiment is one of panic, one of high volatility. It's very headline driven, very short term. So the recommendation is to be light on your feet, be fast to roll over your stop losses, and to be trading scalping, volatility based, and intraday. The political climate is one based on the US election cycle at the moment. It's very candidate driven. Anything positive for Bernie Sanders is more negative as a sentiment for the US economy. When I say that, I mean the US dollar. I am not being prescriptive or descriptive of my own views on these two presidential candidates. Anything positive about Joe Biden is positive sentiment for the US economy and the currency. So this is reflecting, however, only intraday momentum, as this does not seem to be enough to supersede the overall bearish sentiment that exists as a result of the coronavirus fears. And from an investor standpoint, we're looking at fear and opportunity. There are large investors who may be facing margin calls and may be forced to liquidate profits where they have profits, such as gold. That's what happened when gold sold off by a significant amount and then rallied shortly after. This will cause the occasional sell-off in safe haven assets, which is something to look out for. And many investors, large investors like Warren Buffett, who said recently in an interview on CNBC, they are looking at buying the dip. These are people who are not looking at trading. These are not people who are looking at the charts. These are people who are looking at overall relative value over extended periods of time and are simply seeing a quality asset to buy into at a very cheap price. So there may be some of that taking place, which means the markets are selling off, but there will be a lot of bouncing around as large investors do place their positions into the markets accordingly. Overall now, if we take a look, the seasonality data, it is overall irrelevant this month. The overbearing macroeconomic themes are stronger, and I do not expect the seasonality indicator to be something that will be indicative of any market moves this month or possibly even next month. So my bias to the long side on the Mexican peso, the Swiss franc, and of course all stocks, and short on all metals, totally irrelevant. I will be following the sentiment and the commitment of traders data to keep track of the money flow of large money managers. The commitment of traders data does support what I just said, that divergence between the macroeconomics and the seasonality, where we can see that while silver and platinum are shorts, which is in line with the seasonality bias, there is enough indication that gold would be going to the long side, for example. And there's a neutral sort of, in between position on palladium. We can see here that there's a divergence with oil. Oil is supposed to be heading to the upside very strongly, typically seasonally in March. However, for obvious reasons, as we mentioned before, we will not be taking that position. We'll be following the sentiment and the macroeconomic theme of oversupply and that battle between Russia, the United States, and everyone else in OPEC for a dominance of market share. All right, so that is the overall perspective for the week. I will update with trade reviews throughout the week. Thanks for watching.